Well, hello, everyone. I'm Trevin Stratton, the Chief Economist and Senior Vice President of Policy at the Canadian Chamber of Commerce. And I'm happy to be moderating today's discussion on a year of economic recovery with Don Desjardins. A couple of quick housekeeping items before we get started. First, apart from myself and Don, everyone's lines are muted and cameras are turned off for today's session. And second, we collected some audience questions during registration, which I will ask Don later on. But if you have any questions during the presentation itself, please use the Q&A function here in Zoom. We have time set aside for Q&A at the end of the event, but I will also sprinkle some timely questions throughout the discussion. And now it's my pleasure to introduce you to Don Desjardins, RBC's Vice President and Deputy Chief Economist. And so at RBC, Don is responsible for the macroeconomic and interest rate forecasts for both Canada and the US. Welcome, Don.
Thank you, Trevin.
So today's discussion, we're going to focus on all the interesting economic dynamics that are taking place, coming out of the pandemic, looking at inflation, labor market conditions, Canada's economic relationship with the US, the outlook for interest rates, the Canadian dollar, and a number of different items too that I'm sure will come from the audience. But first, Don, I wanted to ask you, that we see vaccination rates going up every day in Canada, and some of the businesses in the hardest hit sectors are starting to reopen now as well. And so it looks like the Canadian economy might be at an inflection point where we're pivoting towards significant growth after coming out what was basically the largest economic downturn since the Great Depression. And so I'm wondering, at a high level, can you let us know what's the economic outlook going forward out of this into the fall and maybe into 2022 as well?
Sure. Well, as you say, vaccination rates have significantly picked up over recent months. And I looked today and it said that, Canada has 51% of its eligible population actually having double dose. So that's really amazing news for the economy. Certainly, it will allow for a more fulsome reopening in terms of, all of those hard hit sectors that have had to really close their doors for such a sustained period of time. Now, the timelines are going to vary by province, but we did see this reopening begin in June, and that's continuing to expand and grow as we worked our way through July. So we're seeing this in the data. The economy bounced back in the second half of 2020, as we'll all remember, but the momentum eased a little bit in the first quarter of this year as we got that second wave that occurred over the winter. And then in the second quarter, of course, that third wave really did weigh even further on the economy's momentum. Now in April and May, we did see our economy actually contract for 2 quarters. And that was the first time in the year. So that's really just showing us how those waves of infections really restricted the ability of the economy to expand at all. But then, as we've discussed, we saw those vaccination rates jump. We did see jobs, which had been cut during April, May, being recovered. And as we go forward, we think June is going to show, June did show a big increase. We think that hiring is going to continue through the rest of this year. So what does it look like? Well, we think that, now again, assuming no fourth wave that puts us back into restriction mode, we're going to see Canada's economy expand significantly in the second half of this year. We think growth will average about 6% over that second half of the year, which is very, very strong. And we think that momentum will continue into 2022 because the industries that have been most significantly impacted by COVID-19, they are going to have to take a significant amount of time, we think, to fully recover. So that's going to carry that momentum into next year. And we think that the economy will grow at about 4% in 2022. So that momentum really being sustained as we go forward.
Great, thanks, Don. And when I'm, looking at some of the numbers, it's interesting to see, what the impacts might be in different regions of the country. Obviously, there are different paces of economic reopening, and there are different sectors in different parts of the country. So I was wondering maybe if you can let us or speak a bit to, whether our national growth outlook will be relatively broad-based across the country, or are there kind of different dynamics at play in different regions?
Well, I mean, as you'd expect, I think there will be variation, but I think that the big message for 2021 and 2022 really is that all provinces are going to expand. The leaders in terms of our forecast would be Quebec, BC, and Ontario. We think they're going to grow the strongest this year. The eastern provinces, they're projected to expand, but the pace of growth is probably going to be a little bit slower because they didn't have quite as significant a decline as many other provinces did. Now, the two provinces, though, that I would say had been most damaged by COVID-19 and the restrictions were Alberta and Newfoundland and Labrador. And I guess that's no great shock because, of course, we saw what oil prices did in 2020 during the height of the pandemic. So these two provinces came under the most significant downward pressure. We saw the biggest drops in GDP in 2020. And although they are definitely seeing, growth momentum build as we go through 2021, oil prices, as we know, have shot back up and we are seeing lesser restrictions. It's going to take them longer to regain that significant loss in output. So when we think about when will economies kind of become whole again in terms of where they were pre-pandemic, I would say Alberta, Newfoundland, and Labrador, they're going to go into 2022. The rest of the country, the rest of the provincial economies, we think will have totally mended or regained that lost output by the end of this year.
No, and that's an interesting trend to see too. I mean, a lot of the provinces that are seeing the biggest rebounds this year are also the provinces that took the larger hits last year too, and so really making up for that difference. I mean, obviously, this isn't only a Canadian story too. This is an economic impact that we've seen around the globe and in all regions of the world. And so, when we're kind of looking around the world at economic recovery too, with, apart from maybe some concerns about developing country potential debt risks there, the global growth outlook is looking pretty strong, similarly to Canada, including a very strong recovery path for the US economy too. And so obviously, because the relationship between Canada and the US, I was wondering if maybe you can tell us a little bit about what impact that might have on the Canadian dollar, on our exports, on foreign direct investment into Canada as well.
Sure. Well, I would say the US is about a quarter ahead, I think, in terms of the more fulsome recovery and reopening of their economy. We're actually watching the data, and it suggests that US GDP expanded double-digit pace in the second quarter of 2021. So that's quite significant, and it's going to really get them back to where they were prior to the pandemic. So that's a pretty strong rebound. Now, what's driving that, of course, is the fulsome reopening of the economy, the fact that there's so much pent-up demand from consumers. They have amassed significant savings on their balance sheets. We are seeing the US labor market recover, so that's helping. I mean, it hasn't recovered as much as the Canadian market has right now, but we think that's going to pick up steam as we go forward, and we'll start to see, business investment also increase. Low interest rates and persistent government support. Lots of stimulus packages being unveiled by the Biden administration. And in fact, even as we look to 2022, that fiscal support, the infrastructure spending, for example, that's going to add to that economy's growth rate. So, the US economy probably growing about 6.5% this year. And based on an expectation that that infrastructure money gets in place, we'll probably see 3.5% growth in the US in 2022. So that's the backdrop that we're seeing. Now, as we think about what that means for Canada, well, certainly there will be some pass through to Canada. We think that export growth will be strong in both the second half of 2021 and the first half of 2022. But we don't think the pass through will be typical. Usually when we say, okay, if stimulus is going to help the US economy by 0.5 percentage point, as we do think for 2022, that about half of that would flow into Canada. But when we're thinking about where we are in the cycle and where we're going to be, we think that the capacity constraints in Canada will limit a little bit how much Canada actually benefits from all of this stimulus being implemented in the US economy. Now, that doesn't mean, as I say, we do think export growth is going to continue to be pretty strong. We've got commodities, of course, in demand, industrial goods, and services exports, which have a long way to catch up. When we think about the currency, I mean, the robust gains in the US economy, weren't particularly helpful for the US dollar because the US Federal Reserve was saying, hey, we need to see a more fulsome recovery. And by that, they mean not just inflation, but also the labor market. And as I said, the labor market in the US has been slower to recover, but I think some of that reflects the fact that they've had such extensive supports put in place by the government. You have seen workers who are essentially better off just waiting and staying on the sidelines and taking the enhanced employment benefits. And about half the US states are going to pull those back in early July, or half pull them back. So we'll see some more people entering into the labor market. But it was that sense that the Federal Reserve was thinking, well, we don't think inflation pressures are anything but transitory. I think inflation pressures continue to be relatively modest after we take base effects and the like away, and the labor market continued to be weak. So they were signaling that, they were in no hurry to taper the quantitative easing program. They were in no hurry to raise interest rates, and the US dollar suffered as a result of that. Now, here in Canada, as we know, the Bank of Canada has already started to taper its quantitative easing program, and they've indicated that rates are likely to move up in 2022, because that's when we'll get our output gap eliminated, and that's when inflation will be sustainably at 2%. So that was positive for the Canadian dollar. And then you layer on this recovery you've seen in oil prices, and it was really good news for the Canadian dollar. So it's been trading at about 80 cents or higher since April. And that was the highest we saw since 2015. Now, as we look forward, the Canadian dollar, we think, probably going to hold at these levels. You'll still see these high oil prices supportive, but we've seen a change in tone recently from the Fed. They seem to be a little bit more, maybe we need to consider reducing the size of our quantitative easing. We're going to have to pull back on that a little sooner than we previously expected. And it seems that markets anticipate the Fed will start raising rates in 2022. So these factors, have kind of mitigated the positive for the Canadian dollar in weighing on the US dollar. So we think it's kind of a wash about the high commodity prices, in particular oil, against that change in view about the US dollar outlook. So definitely, I don't know that's going to have a huge impact in terms of export growth for Canada as we move forward with a steady currency. When we look at foreign direct investment, we've seen foreign direct investment dwindle in energy and mining sectors into Canada. They've remained relatively, flat in recent years outside of that sector. So we've seen, some dollars coming into Canada. Now, Canadian investment abroad has continued to be bigger than the inflows into Canada. So the gap's narrowed. Canadian dollar, of course, makes it cheaper for Canadian companies to invest by other companies or increase their spending on plant and equipment there. So we could see some persistence, I guess I'd say, in terms of foreign direct outflow.
No, thanks for that, Dawn. And you're actually kind of spurred quite a few questions coming in from the audience related to to that too. One of which was with high oil prices, what's the impact on the loonie, which I think you addressed. But when we're talking about kind of the international landscape or the global economy, it was interesting that you mentioned the services sector, because obviously that's taking a bit longer to recover than the goods producing sector globally. When it comes to trade in particular, having to do with transportation and tourism as well. And that's actually a reversal of the growth in trade that we've seen over the past decade too. But similarly, we have a question about, when we're looking at the global economy, but also domestically, what are the emerging sectors that you're watching with keen interest? And also, is cannabis or value-added agriculture, lab-grown meat, single plastic replacements, et cetera, some of the ones that you're flagging?
Yeah, I mean, what we've been looking at recently, of course, just given the world's interest, of course, in climate change and in ways to mitigate our emissions. Looking at electronic vehicles, looking at electric vehicles, looking at, the batteries, all of the rare earth minerals which Canada has, how do we feed into that chain? So we're not, and again, yes, feeding some of those inputs into the US, but also creating an infrastructure here in Canada where we're creating the batteries themselves. Carbon capture, clean technology. These are the types of things, and of course, agriculture. So there's lots of roadway, I think, for Canadian companies to really latch on to this. And when we think about the US and the Biden administration and the way they're trying to position themselves in terms of sort of reshoring, I think there's room there for Canadian companies to get part of that sort of a North American building it here. And certainly when we think about our educated workforce, we think about, what our companies are actually doing already, just being able to scale that up. I think that's a really big opportunity for Canada as we go forward.
Great. And there was another one, since you mentioned, some of the stimulus programs that are in place in the US, but we can also talk about Canada. There's the question, when will the government start to reduce or eliminate the various COVID stimulus programs, and what impact will it have on residential real estate market and also on employment?
Yeah, well, I mean, I think the government is aiming to really get most of the programs completed by September, and based on the idea that at that point, our economy will be more fulsomely reopened. We'll have more workers that get their job back because some of the hard hit sectors will be able to reopen. Now, I don't think we argue that, everyone's going to get the job they left back. I think some of it's going to be changed. We think about, retail trade, e-commerce, which, was coming, but certainly really had its day and it increased significantly. Maybe you're not going to need as many retail people in stores, but you may need more people in warehouses to fulfill those orders. So I think there's going to be some changes. But in terms of the fiscal side of the equation, I think it is that pivot. The economy starts to really build momentum, has its legs firmly under it, and we'll see the government, be able to just pull back on the supports, and certainly that's, we'll see the income growth come from wages and salaries, because that's one of the things that has been, truly interesting when you sit back. I mean, I don't know about you, Trevin, but I was like, okay, we looked at the supports in place and we look at who was unemployed, and these were generally in the lower wage industries, and we got people, being supported. And you look at the people who maintain their jobs, well, they didn't have a place to spend that money. So we have seen household balance sheets just explode with excess savings, $250 billion. It's startling to me that if I would have thought about what's a pandemic look like and how does that impact household balance sheet, I have to tell you, I would not have said that. So certainly it is the case that when we think about the housing market, yes, it has continued to, really grow much. Again, another thing I would not have expected in a pandemic, that Canadian housing markets would, go through the roof. And we have started to see that ease off a little bit. But in terms of even when those government policies, end essentially, I think that we have a lot of savings on household balance sheets that can be deployed to pay down debt. And I do think job creation is going to take up some of that slack as it occurs.
Well, that's actually the kind of perfect transition to my next question, because I want to shift the focus maybe to jobs, and obviously we saw the latest jobs numbers come out on Friday last week. And so those numbers certainly, demonstrate that the labor market has improved and is improving, and some of that might have to do with reopening and pent-up demand as well that you were just mentioning, though not perhaps without new and emerging challenges as well. And so I was wondering if you can tell us, what do the numbers tell us about what, all these things that we're hearing in the media about possible labor shortages in Canada, particularly the hardest hit sectors?
Yeah. I mean, as you say, we have seen a pretty responsive labor market through all this time. The job losses in April, May, the big increase that we saw in June. Now on that, we're still running with a shortfall of about 340,000 Canadians who were working February 2020 and aren't working today. And it is, as you say, I mean, it's varied, but it's very much focused on those hard hit sectors: travel, recreation, food and accommodation services. So we look at surveys, and it's interesting to see what businesses are saying. Certainly some industries which have been able to more fulsomely recover just because they were able to, they didn't have close contact, they weren't in those spaces where they couldn't, keep their businesses running or get them started once COVID, the first shock, went away. And they have for some time been saying, yeah, it is labor shortages we're worried about, and in particular skilled labor shortages. But as time has gone on, what we've seen is as demand starting to heat up again, we're seeing not only companies telling surveyors that, yeah, it's labor shortages, but it's not just skilled, but it's also unskilled labor shortages. And as well, when we looked at the data for the first quarter, the number of vacant positions was right back to where it was pre-pandemic, 550,000. Like, that's a lot of people, a lot of hiring that is going to get underway. And just yesterday, we released a paper also kind of looking at the labor market supply. So looking at the data, it shows that the number of people who quit their jobs, okay, in the last quarter, so between April and June, that's risen to the pre-pandemic levels. And if you recall the pre-pandemic levels, we had a very tight labor market. So people were quitting because they were dissatisfied and they thought they'd walk across the street and get another job. And we've also seen a significant increase in the number of people who are retiring. So, it kind of says that while people were sort of stuck when the pandemic was underway, these same people said, yeah, you know what, I'm done. I'm unhappy, dissatisfied with my job, or, I've stuck it out, but I'm going to retire now. So when we think about the numbers, so these are growing in numbers at a time when our immigration numbers have had to come down. Like, we have seen, growing number of people become permanent residents, but they were already here. They were temporary residents. So you got not the inflow we need to necessarily mitigate these people who are leaving the labor force or transitioning jobs. So from an employer standpoint, it's looking at, how do I track these people who say, I was dissatisfied working here, but how do I get you to come and work for me? So though that's one thing. We also looked at immigration numbers just as they are. And so the government has, as we know, an aggressive target in terms of getting 1% of Canada's population growth in terms of getting people to come to Canada. So we were looking at, well, what if you wanted to keep, your working age population, so 15 to 64 years old, as a relative share of your older population, so your dependency ratio. We want to hold that steady. You need a 2% population. So, again, even though we have lofty goals and they sound big on the immigration, I think we are going into a period where labor shortages and tight labor markets may, in fact, be a real challenge for business.
And we actually have a question coming in as well about your view related to skilled labor being available to take part in the reacceleration of the economy. So the question is, will we have a brain shortage?
Yeah, I mean, I certainly think that what we've seen over the past, and I mean, even this predates the pandemic, is that skilled labor shortages, that was something you were hearing consistently when you were talking to clients, talking to business. They were constantly saying, we're really struggling with this. So it is one of those areas where I think, that is a real growth area. That's where we're going to see people, pivoting and thinking, okay, well, this gave me an opportunity to figure out what my career should be and what kind of trajectory I can take. Now, that's not, I'm going to become somebody that has this skilled trade knowledge. It's not going to happen. So, that is, I think, some of the programs we're seeing governments trying to work towards, to really try and help people get into these streams of industries that are going to be the growth. And of course, once we can open our borders, get more people to come to Canada, again, that's going to be a source. But in the interim, I think it will continue to be a real challenge for companies.
Yeah, and that's, maybe speaks to the importance of some of these reskilling and upskilling initiatives that we're seeing as well. And so, Governor Macklin was speaking at the Canadian Chamber in the fall last year in September, and his speech was partially on the different impact of the pandemic on different people in the Canadian population. And during the pandemic as well, we've seen the coining of the term "a she session" too. And so I was wondering if maybe you can also speak about the impact we're seeing in the labor market when it comes to the inclusiveness of our economy.
Yeah, yeah. I mean, that's one of the things early on we try to just figure out who's being hit hardest by the restrictions we've had to put in place because of the pandemic. And what we found, and this has persisted throughout the time piece, is that women have been disproportionately hurt by the pandemic. Of course, it reflects a few things. One of them being the industries that women work in. A lot more of the social contact industries. What it also showed us, though, that some of the lower wage really it's the low wage industries where we have seen the majority, if not all, the job cuts. If you look further up in terms of wage, average wages, professional service, for example, those jobs are being created there. So, we can see that now some women, when we looked at the data, had left the labor market completely. Many are still just unemployed. When we look at that number, that 340,000 I was talking about earlier, 56% of those people are women. And we think about in the context that women are usually about 47.5% of employed. So, it's a disproportionate hit. Visible minorities, we wrote a paper on this as well. When we look at the difference in unemployment rates, again, hit harder. So that unemployment rate gap between visible minorities and non-visible minorities moved to 2.5 percentage points. Now, that was 2.5 percentage points about 20 years ago, but there'd been an improvement, and that improvement got erased during the pandemic. So there certainly are parts of our population that have really borne the brunt of this pandemic during the downturn. And really, this is who we have to make sure we bring along as we move forward.
So we kind of, mentioned a tightening labor market that businesses might be grappling with going forward in Canada. But along with that, there's quite a bit of government spending. Obviously, we've talked about pent-up consumer demand, possibly supply side challenges as well. And so these are a few reasons why some economists see a risk of inflation over the longer term. But many other economists kind of see our current situation as temporary and due to base effects and nothing to see here over the longer term. So for you, do the numbers kind of indicate that inflation is temporary or more of a longer term concern?
Well, I think, when we're looking at what's happening, and as you cite, we've got lots of shortages in the supply chain. We've got shortages of labor. And these things over time could definitely have an impact in terms of pricing as people, have to compete for labor, compete for inputs into the production process. So we look at it, and of course there is the base effect. We all know that in 2020 prices were declining, and so the math itself just boosts that rate as we've gone through this period of time, as we've transitioned into a more normal pricing environment. But there are certain areas where, we're starting to see indications of how these shortages, for example, might be coming into play. If you look at new cars, for example, those chip shortages, you look at, rental costs, the fact that fleets had been, totally disseminated when the pandemic hit, rental fleets, and now people are trying to rent cars and it's costing them an arm and a leg. We look at homeowners costs, all of these prices moving up. So definitely there are areas where, yes, there's the base effect, but there's also some underlying suggestion that there might be something a little bit more at play. It might be more sustained than just these transitory moves. So, when we look at the full reopening of our economy, we look at travel services. Well, of course, their prices are right through the floor, but that's going to come back as demand comes back. Clothing, conceivably, we'll start to see some increase. We saw that in the US report today. Clothing prices up about 5%. So definitely there could be something in there. And we think in the near term, you're probably going to see inflation rates in Canada, north of the upper end of the Bank of Canada's target range, that 3%. So we think that's going to be a mainstay for the next 6 months. And as we go through 2022, probably going to see some easing off. Some of the transitory impacts will come out and we'll see, but we still have both the core rate and the headline rate at 2.5%. So still, on the higher end of the Bank of Canada's target. And we're seeing this also in the inflation expectations. I think this is probably something that we even more mindful of. You look at the surveys, the Bank of Canada survey, consumers expect inflation to be 3% in a year, be 3% in 2 years. And so that's a sustained period when they're expecting inflation pressures to remain at the high end of the target. 86% of businesses in the bank survey said that they inflation will be 2% or higher. And that's that's not really a normal situation. I wouldn't say that that's something showing an increase in price pressures and expectation of price pressure, as well, of course, market-based inflation expectations having picked up. So, it's all to say, yes, some of this is definitely transitory. It's math, just plain and simple. But we really, I think, have to be mindful of looking at it through the lens of, are there trends in there that are going to be more sustained, and are workers going to be looking for that in their wage packets as we go forward? So, to be determined. As you can see, at 2.5% next year, we're not, sort of saying it's 5-10% inflation. We do think, some of the math is going to work to temper it, but I think I would say I am keeping a bit of an open eye with respect to, are we entering a different type of inflationary cycle than we've had recently?
So then, if we're looking at that trajectory into 2022 and over the next 6 months and beyond, what can we expect from interest rates then, or what can business owners expect?
Yeah, I think interest rates will go up, but it'll be really gradual. As I said earlier, the Bank of Canada's already tapered its purchases of bonds, meaning, they're sort of feeling that they don't need to be as active to keep longer term yields as low as they are. So we think they'll probably wind up that program in terms of new purchases by the end of this year. And then they'll start, they'll just keep reinvesting as maturities occur. And we think that they're probably going to start to talk about raising interest rates sometime, in 2022. We think they'll actually be doing so in the third and fourth quarter of next year. So we have rates moving up by 50 basis points over the course of the second half of 2022. I think the thing about it is, at this stage, is that although we all see what's happening and we're all confident that everything is going to go back to the new normal, there's still going to be some, I think, residual concern about new variants, what happens in the fall, what happens when we do reopen. And so from the central bank's point of view, I think they're going to have this layer of caution, and they're not going to rush to do anything until they really feel that this is truly in the rearview mirror. So we do think that we will see, the policy rate rise, but again, it's going to be a year from now. It's not going to be it's not imminent. You could see longer term yields, start to move higher. They've come down a lot recently. They were up, now they're down. But we could see them move. We have a 10-year yield about 1.3% now. Could end the year at about 1.7 and move towards 2% at the end of 2022. So you can see that these are higher rates than we're talking about today, but it's not enormously higher.
So, where rates have been basically since the pandemic started, we've seen a significant amount of borrowing, a relatively hot housing market, a relatively robust stock market throughout most of that period. At the same time, Canadian businesses, household, governments have taken on a lot of debt during the pandemic as well, which could potentially pose a problem if there is an increase in interest rates or an increase in debt servicing costs going forward. So I was wondering, when you're looking at Canadian balance sheets, what is it that you're seeing?
Yeah, well, definitely. We've seen an increase in debt accumulation from all of the elements that you discussed. On the household side, I mean, it's that 250 billion in excess savings, which is also a really big factor. And what we've also seen is that Canadian households have not been as active in terms of amassing non-mortgage debt. You know, those numbers are more slanting downwards. It's mortgage debt. And the reason that's important, of course, is because 80% of mortgages, I would say mortgages are fixed term. So it takes, you know, a while for interest rate increases to actually have any impact on that. Doesn't say that it won't impact, but it is to say it's going to take some time. And when we look at debt service costs, today they're about a full percentage point below where they were pre-pandemic. So there's a little bit of room there. And again, that savings bucket is certainly going to help households get their way through this period, especially if some don't return to work right away. Now, when we look at non-financial corporations, their balance sheets, they have a lot of cash too, a lot of cash on time. We have seen, you know, some businesses tapping some of the government programs. So we've seen some debt being increased. And for some small businesses, it does show, according to surveys, that, you know, that's going to be constraint in terms of their ability to invest going forward. So you know, that's something to keep our eyes on. But certainly, you know, there will be room on these balance sheets, on some companies' balance sheets, to invest. And that's, of course, going to be key as we move forward to ensure we increase our productivity and meet this whopping demand that's likely in the pipeline. Finally, on governments, well, we know that governments really came in full steam to help mitigate the very severe impact that could have been reaped on our economy should they not have been doing that. Certainly when we look at the federal government, you know, their deficits obviously very large. It has changed their debt to GDP ratio trajectory quite considerably, added you know, about 15 percentage points. So, you know, granted, you know, this is just something that is a byproduct of the pandemic. It's not made in Canada, it's across the globe. So every country's experiencing this. And we have seen provincial governments similarly, you know, either doing it related directly to pandemic or the recovery. We calculated about $72 billion from the provinces, you know, actually really there to help get us out of this mire. So, you know, all these levels of government have seen a significant increase in their deficit levels, in their overall debt to GDP. Now, growth is going to swing in the favor of these balances as we go forward. And in particular, if we see some unwinding of these programs or just even stopping of these programs as we, you know, go through the near term. I mean, at the federal side, we know they're going to spend $70 to $100 billion over the 3-year period. They've committed to doing that. So they'll be slower somewhat, but they are also going to benefit from increased tax revenues as we finally, you know, get back to business.
Great, thanks, Dawn. There are quite a few questions coming in from the audience, so I want to try and get through as many of those as possible. I did just want to remind everyone watching that you can enter your questions in the Zoom screen in the question and answer function. So the first one is there any effect on the economy to note if an early election is called in Canada?
I mean, that's always a very tricky one. I think right now, just where people are, you know, we're all just trying to rebuild our lives and getting back to it. So, you know, I don't know that that would have any substantive impact. And I don't know that if we look at elections over time, I mean, I have to say, I haven't looked at this in quite a while, you know, that you see a substantial, if there's a significant hit to confidence, yeah, you see people pull back. But I think just the extraordinary environment we're in, you know, if people can actually work in a thriving economy, and I don't think it will have an impact per se. That would be my thought on that.
Okay, the next question is about the global economy. So what's the outlook for international trade, specifically with China, and how will supply chains be impacted?
Yeah, I mean, this is something we've also taken a look at. And the global economy, you know, is anticipated to grow, I think about 6% this year and 4.5% in 2022. And a large, you know, we have all the advanced economies moving forward, but China, of course, on the on the emerging and industrializing countries really being a big powerhouse there. Now when we look at the supply chains and all the interruptions we've seen, it could be that for Canada, we can forge trade relationships with a lot of countries. And it will be more the case, I think, in terms of some of these supply chains, are Canadian companies going to look south of the border if we start to reestablish some of these supply chains within North America? So, I think there is opportunity for Canadian exporters. Certainly when we look at Europe, we look at a variety of countries that are, going to be struggling, but they're going to get out of this pandemic related downturn. And so that will be, I think, one of the factors that's going to help us as we go forward. But again, when we're looking at where the strong growth economy is, yes, China is definitely a strong growth economy, but we're also seeing our neighbor to the south of us growing very rapidly. And so that may present opportunities, greater opportunities as we go forward.
There's another question related to supply chains, and that is, do you have any comments on the economic effects of the current disruptive supply chain issues, for example, components, freight, etc.?
Yeah, and this is what we're seeing in terms of manufacturing in Canada, whether it's on the auto side or other manufacturing industries, which, either they can't get the inputs in, freight costs are extraordinarily high. We do hear this from clients that, it really is a struggle to just to get the inputs, let alone to pay for them because the prices have moved so significantly higher. And definitely when we're looking at auto production and when we're looking, and so this is, one of those sort of, it's the supply chain, but how is that impacting the price outlook as we go forward? So I think that's something, we are all pretty much concentrating on trying to figure out, are these supply constraints, really going to impede the ability of the economy to grow as we go forward? Now, our baseline doesn't really assume that it's going to cause a huge interruption. I think we're kind of experiencing and we're starting to see some of these factors loosen up a little bit, which is really good for the outlook. But certainly it's something to be, something we're monitoring and to be mindful of.
So there's another question related to the energy industry, and we talked a bit about the impact on the Canadian dollar and the kind of impact on the rebound of the Canadian economy this year of higher oil prices. But over the longer term, what do you think will be kind of the impact on energy prices and the energy industry of Canada kind of gradually reducing its carbon emissions?
Yeah, I think, when we're looking back, in the near term, it seems likely that energy prices are going to remain relatively high. And certainly, again, it's not something you necessarily would have expected, given where we were, whatever, 16, 17 months ago. But they seem, given the constraints on supply and whether OPEC, is going to increase production or not, that seems to be quite a debate within that organization. And as we look forward, in the near term, we are, I think, seeing activity in terms of rig counts and picking up in Canada. Will that be sustained as we go forward? I think we are seeing evidence that, Canadian companies are embracing technology. They're looking at carbon capture. You see lots of headlines. Companies are really trying to figure out how they can pivot and still continue to produce, but at the same time, looking at it in a way that is at a lower level of emissions, whether it's the carbon pipeline or the carbon capture that's underway, all of those things. So, it's still going to be, I think, an industry in Canada as we go forward. It might look a little different, but I don't doubt there will be one.
This is an interesting question, almost existential for economists right now, actually. So are you finding that there needs to be changes in the tools of economics because of the way the economy reacted to the global pandemic?
Well, I'd say yes and no. And that is the perfect existential economist answer on the one hand. but I think what we saw was, we looked at the models and when we were seeing our economy collapse, they were broken. There's no doubt about it. But as we move through time, we have been able to see that some of what the expected results are do materialize. Like it is pretty amazing. But having said that, as we move forward, we know the economy has changed. And we have to ensure that when we're thinking about what's the next driver of economic activity, how do we ensure, that we understand all the drivers of the labor market, how the composition of our economy has changed, because I would say there's no doubt, I always think of that e-commerce because it kind of blows me away how the numbers just change so dramatically. And we're always like, oh, e-commerce isn't a big thing. And now it's, the biggest thing. So, how people are going to work. So definitely, I think in terms of, we're looking at how do we think about the economy? Well, we do have to kind of move our minds and broaden out what we're taking into account. But at the same time, when you think about the usual drivers, are interest rates going to be as impactful as a tool when we go forward? We think they are, but it's going to remain to be seen, especially, how far we've come. And our central banks, for example, changing. And I think it's for a lot of central banks right now, they're looking at, well, should we have a more fulsome mandate? Should we not just be targeting inflation? Should we be looking at a mandate that includes labor markets? I think that's an ongoing dialogue at the Bank of Canada. So, we have to definitely change the way we model it. But I think, our foundational understanding of how economies work, it's held up reasonably well. I have to say, I'm a little happy. Don't have to go relearn it all. Just add to what we know.
A question about the labor market, or rather in the jobs numbers we saw on Friday. There was a very positive increase in youth employment when it comes to younger Canadians in the job market, and those numbers were not great last summer. That's for sure. And so the question is, how do you see Canada's labor market recovery in late 2021, especially in terms of entry-level job graduates?
Well, I think, and this is sort of on all of this other stuff we've been talking about with these surveys, with these labor shortages, I do think that increasingly, companies are going to be looking at people with potential, right? They just want to know that this person's eager, and they're not going to be looking for, hey, you have every single thing that I could ever want. They're going to be looking at people as someone or an agent, an input, I guess, to invest in. And I do think that was even starting before the pandemic. I think skills are evolving so quickly and they're changing so significantly that when employers are looking for people to hire, they realize that they're going to have to invest. We look at things like, internships, all of these different programs. And I think, at RBC, it's definitely a real area that we lean into, because they realize that if you give someone a summer job or an internship, you kind of take a test drive and see what these people, and see how they, grab the skills. We have a program called Future Launch. It's a program that really just says, hey, you got a year, you're going to explore all parts of the bank, and just to see how people, and, taking that attitude, I think, towards hiring really does build, people may not want to stay at RBC, but given that they do get some skills, it helps them move to their next position, or it helps a company like RBC, really get some very quality people. Yeah, they don't know everything, but you can see the potential and the ability to learn and grow. And that is going to be essential, especially in an environment where we are going to see a lot of baby boomers retire. Demographically, people are, and as I said earlier, some of these people are actually doing it now because they're kind of like, whoa, after going through this, I need to get living my retirement years. So, there will be, I think, opportunities there.
Well, that's actually, shifting from the entry-level job market to retirement. There's another question here about that, being that what are some of the industries that will be attractive for investment as we enter economic recovery for personal retirement savings?
Wow. Well, let me tell you, I'm not a personal retirement planner. So, I'm looking at it through a different lens. I really do think that, the lot of the new technology that we're seeing, whether it's clean tech, green tech, these are the areas where we certainly have seen a lot of investment dollars flow. So I'm not looking at it as an investor. I have to say that's not really the lens I take on these things. But certainly when you think about areas of our economy, whether it's in agriculture, whether it's in manufacturing, these are areas where we have seen investment getting put to work. And I think that's sort of where we're going to continue, especially as we go through a period where, we've had a real reduction in the amount that we can supply. We've seen people, not working. We've seen factories idled. We've seen a lot of things. And as we move forward, there's going to be real challenges. How do we get us, more productive, I guess I'd say. So I think that's where we're going to see a lot of that activity in terms of spending. And as I say, businesses themselves have lots of money on their balance sheets. So the ones that are emerging here, I think they're going to get some of that money to work.
So a question here about tax policy. Do you foresee any major policy changes in terms of taxes, specifically capital gains taxation?
It's definitely a looming question. What is the timing in terms of the government's, really having to look at either the revenue sources or their spending side of the equation? Because, we've had to go through this period where things had to be very stimulative. And, that's going to continue, I think, until we see, we know that it's in the rearview mirror, as I've been saying. So that could take some time. But one sort of the other is going to have to be changed, I think, as we go through the next 5 years. We look even at the deficit, relative size of the economy. The federal government has a 1% deficit over that 5-year period. So it's very big, and then it comes down, but still 1%. So something's got to give there, especially if we are going to see interest rates move higher, because the debt service costs are going to take a bigger bite. So, definitely there will be something, I think, in the horizon. Now, are they going to just hone in on reducing sort of program spending, reducing the size of government, or are they going to look to the revenue side? And it probably will be, I think, a mixture of both. I'm not sure the weighting of that, but I think, something, they're going to need to do something if they are going to eliminate the deficit over time.
That's the $1.4 trillion question for the government, right? One more question. Do you find that the fears for increased inflation expectation in the US will translate to real inflation? And would this possible higher inflation flow into the Canadian economy?
I mean, that is, and that is the key thing here. Our agents, economic agents, people, businesses, markets, are they going to have confidence that central banks will do what they need to do to slow an economy that's too hot, that's going to perpetuate higher price pressures as we go forward? Now, I think at this stage, we've had a long history of inflation targeting by these central banks. They've been incredibly successful. And then, so your question, I think, is exactly the right one. Because of the myriad of factors that are putting upward pressure on prices right now, are people going to start to demand that in their wages? Are they going to expect that, every year it's not going to be this 1 to 2% wage, they're going to need 3 to 4. And that really will start an inflationary cycle. Now, I think central banks, while they are definitely right now, I think, playing it cool, if you will, in terms of saying, we want to see a fulsome recovery. We want to see our economies get back to whatever normal looks like. So we're gonna just keep policy stimulative, being mindful. So I think, if that gets a little bit too prolonged, if rates remain low for too long, that could start this inflationary cycle that people are fearing. So again, our forecast, looking for above 3% inflation for the remainder of this year and 2.5% next year. That's really predicated on the idea that central banks will, get into action and start to reduce some of that stimulus as we go forward.
So Don, before letting you go, I just wanted to ask you kind of one final question, and it's about growth in Canada. Obviously, we're coming out of a huge economic downturn. We're looking at economic recovery. We're experiencing, or probably will be for the rest of this year, a pretty significant, and lecture too, a pretty significant rebound. But in terms of long-term growth, in terms of maximizing Canada's growth potential, maximizing business investment, creating jobs, and enhancing productivity going forward. I mean, what do you think it is that Canada needs to be focused on?
Well, I think it is, a few things. I think it's sort of within the country, looking at some of the impediments to allowing trade within the provinces, interprovincial trade, as an example. I know I feel like I'm always harping on this, but it is something that I really think is really important. Um, you know, we have small markets when we just have it in our provincial. If we allow us to at least trade across our country without impediments, I think that's a really important and forceful a factor that will allow our economy to continue to grow. I think it is also, the idea of investing in technology and investing in people. So whether it's this reskilling, as you cited, the government programs, that trying to get people into position where they can continue to develop their skills and take advantage of the technology. Certainly not everything is going to be done by robots, but we have to realize that this has shown us that technology can be a force for good. So let's kind of look at how we can be investing as companies in technology to really, and then getting the staff, to be able to use the technology. I think that's going to be the key to increasing our productivity and our overall long-term growth potential.
Great. Well, thanks so much for that, Don. Economists right now just use so many moving parts and so many dynamics that your insights are incredibly instructive for all business owners across Canada and businesses. And so it's great to hear about what's going on in your mind and what you're thinking about right now too. So I want to thank you for taking the time, RBC as well. This was very useful for me in terms of my own economic thinking too. It was great to hear from you. I want to thank everyone for attending today's session. The video will be available afterwards as well, in case you're interested in listening to it. Otherwise, have a great day, everyone.